Hi guys, I'm Nishi and I'm an ACCA trainer. Apart from that, I also do take corporate training sessions and I'm also an ASM 50 module trainer, mutual fund trainer. Okay? So today I'll be teaching text F6 and this is for Financial Act 2023. Okay, I'll be teaching this capital allowance topic. Just a second, let me share my screen. Okay. So this capital allowance topic, I know many students face difficulty in this topic, but trust me, guys, this is one of the easiest one. Okay. Uh, just like try to remember the things. That's all. Okay. Now let's understand what is capital allowance. Capital allowance is similar to your depreciation. Just a second. Yeah. Capital allowance is similar to your depreciation. Just how you calculate depreciation, you calculate on straight line basis or the reducing balance basis, everything on that. Okay. Now the thing is, there's a difference. Like the tax department does not allow you to. They don't consider this depreciation as depreciation is considered as an estimate. Okay, an estimate is something which can be manipulated. That's why the tax department does not. Consider this depreciation. Instead, they give you capital allowance. So yeah, now capital allowance. This is whatever the capital allowance you get per year. Just like depreciation, this is also treated as an expense. Okay, this is treated as your expense. Okay. Now, whenever you purchase your plant and machinery, this is calculated on your plant and machinery. Whenever you purchase, at that time you do this, and later on for the next period, for the following periods, you do it on the reducing balance basis. Okay, so yeah, on plant and machinery, and this is only for the business use, obviously, right? Plant and machinery, office equipments. Cars, but cars have separate rules. Okay. So you get capital allowance on all of these assets. Okay. Now there are total three types of capital allowances. Three types of capital allowances. One is three types. Okay. One is your annual allowance, annual investment allowance, investment allowance. Which is AIA. You can say this as AIA. Okay. Now AIA is available 1 million per year. Okay. Per year in the sense for 12 months. 12 months. Okay. And this is per company. So if there's a group company, then you will divide it for according to the group. And if your accounting period, if a company is having accounting period less than, let's suppose 12 months, or let's say it is 4 months, right? 4 months is the accounting period. Then 1 million will be divided by 12. You'll get monthly annual allowance, multiply 4. So you'll take whatever to like 50,000. Get it? Yeah, you get. Okay, this is your 4 year annual allowance for that particular year. Just a second. Okay, no. There's a calculation error. If you divide it, you'll get different answer. Just a second. 1 million multiply 4 divide by 12. which is you get 666. Sorry, 3 times 6. 6 times 3. Okay. Uh, okay. Now, this is how you will calculate. This is known as time apportion. So, whenever you have a period, in case suppose you have, if a company is having accounting period more than 12, then you will whatever the period is. If it's for 18 months, then 1 million divided by 18 multiply 12 will be your whatever answer you get. This is how you will calculate the capital allowance, and that is on the time apportion basis. Now, capital allowance is claimed per year. Okay, you get 1 million per year, and except cars, any assets can be set off against this one. Okay, except cars. The reason is, we'll discuss for cars, there's a separate capital allowance. This annual investment allowance cannot be set up for the cars. Okay, cars only qualify for main pool, special pool, and FIA first year allowance. Okay, so this one was your first annual allowance, and now we'll see written down allowance. Allowances, which is WGA. Like you calculate per year. Yes. See, in this you have two types of allowance. One is main pool assets, and second is special rate pool. Special. Okay. And for main pool, the allowance per year is 18%. See, this is per year and this is for 12 months. Okay. And this is 6% per year for the 12 months period. Okay. Which means if you have the accounting period more than that, then you will have to, like you have to time apportion it. Okay. And one more thing, for in the special rate pool, there are separate set of assets which are included. First one is your, first, left and escalators. Laters. Okay. Then comes your electric thermal heater, lighting system, then cold water system, your heating system, water heating system, your ventilation, air conditioning. All those are a part of your special rate pool assets. Okay. Now, the second type of assets is long life assets. So, long life assets having a useful life more than 25 years, 25 years useful life, those assets which have useful life for more than 25 years and which has the minimum expenditure, at least 100,000 pounds per year expenditure on it. Those are classified as your long life assets. Okay, those falls under the special rate pool asset. Now, there's one more asset which is considered, that is motor car. Okay, cars. Motor car. Motor car, CO2 between more than 50 grams. 50 grams and above. Okay. Now for motor cars, I'll explain. There is a separate, just a second. Motor cars have different rules. You'll able to remember it in this way more better. Okay. There's a classification given. So for motor cars, if the CO2 emission is between 1 to 50 grams, then it falls under the main rate pool, which is 18% allowance is given, which is MRP, right? Main rate pool. Whenever it is 18% allowance is given, that is a main rate pool assets, right? Right. Now, if the CO2 emission is between, it's 51 grams, more than 51 grams, okay, 50 grams, 50, more than 50 grams. 50 gram, more than 51 grams, then it falls under the special rate pool asset. The same thing, right? The same thing. Okay. Now, if your CO2 percentage, if there is an electric car and the electric car do not have any CO2 emission, right? If there is zero CO2 emission, CO2 and electric car, then you don't get these electric cars are not allowed for your annual investment allowance, but they get a separate allowance which is known as FIA, which is first year allowance. Okay. And if your car is second hand electric car, that too, zero electric car, then also they qualify for 18% of your annual allowance, which is main rate pool, right? Okay. Now let's see. That's all. Okay. Except these assets, except the special rate pool assets, all the assets fall under the main rate pool. And also in main rate pool, cars 0 to 50 grams. Okay. This also falls under the main rate pool. And other assets, except your lift, escalators, heating system, your electric lighting system, your cold water, your space, or yeah, again, water heating system, your ventilation, and except all those, all the assets fall under your main rate pool asset. Okay. I hope it's clear till now. And also, apart from your long life assets, yeah, okay, that's all. Now, let's see for the special following first year allowance. The third one is your FYA, which is your first year allowance. Okay. Now, this FYA is only eligible for your electric car, only zero CO2 emission electric cars are eligible for this. Okay, only these cars are eligible for your first year annual allowance. And also one more thing, you get 100% annual, you get 100% allowance FIA on this electric cars. Okay. All right. Let's do a question. Okay. So we will start with your test year understanding 1. We'll do your test year understanding 1. Guys, one more thing. Whenever you start studying text paper, like it's okay if you make notes for your handwritten notes for the rules, it's fine. But whenever you're practicing questions, please try to practice it on your Excel sheet, because I get many students who, like, whenever they give any other paper, like even if they are giving text or if for ATX and for text, like they couldn't complete the whole paper. And the main difficulty they face is in their 40 marks part. Okay. Section C. In the section C, they face a lot of difficulty. And the main reason for this is lack of practice. Right. So you need more and more practice to clear this. And it's not possible that you at the last, towards the last, you start practicing and you'll get it. No, you have to practice from the beginning. Okay. Don't keep the practice part towards the end, because trust me, towards the end you don't have so much time for writing or typing practice or everything. So start doing it since the first thing. Okay. And one more thing, like start practicing in a proper format way. Don't think that it's just a practice and I'll just do for sake of solving. No, you have to do it with perfection. So once you start doing it, you'll see your difference. Okay. Difference in your exam. Okay, let's do. Ginevra comments trading on 6th April 2023. Her trading profits adjusted for the tax purpose adjusted for the tax purpose, but before capital allowance are as follows. Okay, just one more thing. Okay, one more thing, your capital allowance, whatever capital allowance is, that is deducted from your trading profit. Okay. So yes, you are given the capital trading profit per year. Now you'll deduct the capital allowance from this. On 1st May 2023, Canara acquired a plant and machinery. 1st May 2023. Okay, this is for the year end 2024. 1st May is falling under between this one. That's why this will for the 2024 year end. Okay, acquired a plant and machinery of one, one, yeah, 12 lakh 3,000. A new car CO2 emission of 48 grams, so which is less than 50, right? So if it's less than 50, if you remember the rules, let's do one thing. Let me keep the rules. See this. If it's less than 50, which is under falling under the main rate pool asset. Okay. Now, yes, a new car with carbon emissions of 10,000. So this 10,000 will fall in the main rate pool asset. And a new zero emission car for 11,100. Now, if that's 0% electric emission car, which falls under your FYE allowance. Okay. Uh, Calculate Ginevra's tax adjusted trading profit for both the years. Assume the tax year 23-24 rules apply throughout. Okay. So yeah, we are studying FA Financial Act 2023-24. So that's what they are asking in the question, right? All right. So yes, let's start with the capital allowance working first. Capital allowance working. Okay. AAA, your main rate pool, your allowance, whatever allowance you can claim. Okay. Now, before starting a question, you can do this. All workings are, there's a shortcut to apply pound, okay? Press your Alt key on your left hand side and press the numeric 156. 156. You'll get the pound symbol, okay? Or else you can also add here. It's also fine. Both is fine. Okay, all right. So this is for the year end, 5th April. 2024. So I hope you all know that your tax year starts from 6th April to 5th April. Okay. But for your easy calculation, easy understanding, it is considered as 31st March. But whenever you are given 5th April, don't get confused. That is the previous year. Okay. Previous year tax. Okay. All right. So yes, first of all, let make a proper format. Okay. All the additions will be considered. Additions of the assets. So, plant and machinery. Plant and machinery. Okay, here one more thing. This is for whole 12 months. Okay, so we'll not time apportion your annual allowance. So your value of the plant and machinery is 12 lakh 3,000. Okay, your AIA, you get annual investment allowance of 1 million. That is your remaining plant and machinery. Okay, remaining balance of your plant and machinery. Now this will go into your main rate. Okay. And whatever the annual allowance you claim, I'm adding minus sign to make it plus. Okay, you will take that to the annual allowance column. Now, next is your new car emission. So car for car. Okay, so for cars, CO2 emission, CO2 emission is 48 grams, which is main rate pool asset. Okay, 10,000. Now you have one more car, which is zero emission car. Zero emission car. Okay, for that you have the value is 11,100. You get on cars, you get, see this line on cars again, you get this first year allowance, this one. Okay, this one, first year allowance. So I'll claim that, I'll deduct that one. You get the on 100%. Okay, 100% FIA. This FIA also gets the time apportioned. Okay, so yeah. Sorry. This FIA is never time apportioned. I'm so sorry. Yes. This FIA is never the time apportioned. So yeah, here it will be 0. Okay. Hmm. Whatever the allowance we did, we'll add that. Okay. Now you will see the balance. What is the balance for the main rate pool? Main rate pool balance will be balance. Now you get the written down allowance. Written down allowance of 18% of the main rate pool. If there was SRP asset available, then you would have done a separate column, and then SRP assets, same the total way, just the way whatever we are doing, just the thing will be different. That whatever the SRP assets, those will be the part of SRP pool, and the written down allowance on that will be 6%, and here it will be 18%. So 18% will be a written down allowance. So tax written down value of the main rate pool asset will be your this. Okay. Tax written down value. And this will be carried forward. Okay. For the next year, you'll do 18% on this. And if there is any addition, you'll add it. Okay. All right. So this allowance will also be added. Now you'll see, you'll get the total allowance. You'll calculate the total allowance. Okay. So this will be a total allowance for year end 2024. 5th April 2024. This will be a total allowance. Okay. Now you will calculate for the year end April to 5th April 2025. Okay, for the next year. Now your brought forward balance for main rate pool is this one, right? Your written down allowance again 18%. 18%. Okay. Your pool will be this one. Okay. Tax written down value, and this will be carried forward for the next year. Just like the previous one we did, this will be carried forward. Okay. And for this annual allowance, this is total annual allowance for the year end 2025. Year end 2025. You will deduct this from your tax adjusted profit. Okay, just like you will deduct your depreciation, you will deduct this. Okay, now in question, if you find a question, okay, first of all, let's do this, let's complete this, then we'll see that tax adjusted trading profit for the year 2024 and for the year 2025. Adjusted profit, what is it given? Okay, 1595,740. And for the next year, okay. Now you will deduct the capital allowance. Allowances. Now you have two ways to, link this. In exam, what happens whenever you copy or suppose you have done this calculation, right? This is your working. But for explanation part, I've done this before. Like first of all, I've done this. Then later on, I've calculated the profit part. But if in exam, whenever you do this, this will be a working note, right? So you can name it like it's your working note one. You can name it, it's fine. You name it as working note one and working note two, it's okay. Or else you can also do link your cells equals to minus this one directly. Okay. And same way equal to minus this one directly. But now in exam, what happens whenever you cut paste or copy paste the cells whole, if you cut paste the cells, they don't change the cell number. Like, see, for example, if I cut this and paste here, my values will not change, right? Because the formula is applied same. But in exam, what happens if I do this and whenever I paste this, the cell number will be of this one only. It will not be changed. Like the cell number for this one, this is E40. So in exam as well, it will stay E40. If I cut this and paste it down, this will be, no, just a second, this one. If I cut this one and paste down, this will take this E41 again. But in exam, it doesn't happen. Okay. So it's up to you. Whichever is you find it comfortable, you can take it. It's fine. Now, text adjusted training profit. You get it. You'll get it. Okay. Okay. All right. So in any question, it is given to you guys that suppose directly profit is given. Profit is given. Okay. And whatever the profit is, they say that they have deducted the depreciation. Okay, and the separately depreciation is given. Or else they might also give that there's an asset, suppose profit for the year is 20,000, and asset, there's an asset you purchased and the value of asset is 1 lakh. Okay, and it is depreciation is calculated on straight line basis for 20 years, so you get depreciation for 1 month. So this profit, if there is a profit given, then don't you think you get the profit after deducting your depreciation? So if you get this, then you will add back the depreciation and then will deduct the capital allowance. Okay, so they will definitely trick you the question, and then you will have to answer. It's not going to be very straightforward questions. Okay, so I hope you got it. uh, Now let's do second question. Let's do test your understanding too. I'm using Kaplan kit, Kaplan study text. Okay, you can also refer to your this ACCA study hub. That's fine. Okay, so this is your test your understanding too. Okay, see this. Graham comments trading on 1st May 2023. He prepared accounts for 4 months period end. So if you have 4 months period end given, then you will prorate your annual allowance, okay, according to the number of months present. Ended on 31st August 2023, and then the year ended 31st August 2024, which is the next year. On 1st May 2023, he bought a plant and machinery for 4,70,000, a used car. So if it's a used car with zero CO2 emission, which is again your main rate pool asset, and your plant and machinery is also main rate pool asset. Whatever the balance is remaining after deducting the annual investment allowance, the balance will fall under the main rate pool asset. Same way, right? This one. You can refer to this. So whenever you do text questions, make a separate rule book. And whenever you start solving exam kit or questions, keep that rule book along with you and then solve questions. You'll understand that text is very easy subject. You just have to remember the rules. That's all. You don't have to think a lot, just like audit or PM. It's a really easy subject. Text is easy, very easy. Okay, but it's just a bit lengthy. You have to remember a lot of things. That's all. Okay. So yeah, zero to CO2 emission for 11,500 and a new zero emission car for 16,500. So this is also main rate pool asset, and this one zero CO2 emission asset will fall under your 100% allowance FYA, first year allowance, capital first year allowance. Okay, calculate capital allowance for each period of trading. Okay, this is just the same. The only difference is the capital allowances time prorated. You have to prorate the capital allowance. See this. I'll copy the format for the easy calculation. Period ending 31st August. 31st August 2023. We're in 2024. Okay. Now you have annual investment allowance, EIA. Okay. EIA for year end 31st August 2023. You'll prorate it. You'll have to prorate this annual investment allowance. You get 1 million per year. So 1 million divide by 12, you'll get per month. Multiply by 4, you'll get 4 months per 4 months. Okay. And just for your easy understanding, I'll also write the calculation. Okay. All right. So this is the annual investment allowance, you get it. Now your value of the plant and machinery is 4,70,000, which is 4,70,000. Okay, minus the 6 times 3. Whatever the remaining balance is, that is your main rate pool. If I have copied and pasted the formula, so directly everything is coming. Okay, a used car. So if it's a used car, then it will be main rate pool asset. So used cars, used, zero CO2 emission car. The value of car is 11,500. A new zero emission car is for 16,500. So 16,500, 100% of the first year annual allowance. First year annual allowance. Okay. This is not time apportion. Okay. Sorry. Yes, this is not time apportion. Okay. So, yes, whatever the annual allowance you are claiming, and that is directly going into the allowance column. Just here also, it is directly going into the allowance column. Now, whatever the balance is for the written down allowance for main rate pool, you will calculate written down allowance per year. That is 18% for the main rate pool asset. If it was SRP asset, then again 6% was that. But here it is the main rate pool asset, then that it is your this one 18% of your 147. Just a second. Yes, is there any asset which I am not included? Okay, also one more thing. This is 18% is per year. Now we have to calculate it. We have to time apportion it. Okay, so divide by multiply 4, divide by 12. You'll get per year annual allowance. So 18% into 4 divided by 12. Because this period is only for the 4 months. That's why we time apportion this. Okay? So this is something extra in this question. So you get the annual allowance of this much, and this will be your annual allowance for the period ending 5th year end. Okay, and you'll carry forward this balance. Now the here it will be directly 18%. Here it is for the 12 months period, so you don't have to worry about that. You will get this directly for the 12 months, and this will be your annual allowance for the next year. Okay, for the 2024. As per the question, for each period trading. So yes, we got it for this one and for this one. Okay. And for AIA is also clear. I hope till now it's clear. Okay. Okay. Now one more thing. We'll study one more small topic, a very small topic. We'll complete that. Just a second. Okay. So guys, let's start with a new topic, which is very small. Okay. So it is in the addition of it. Okay. Now, till now we did whenever you purchased a plant and machinery. Now we will do whenever you sell a plant and machine. Sell of plant and machine. Okay. So whenever you sell this, we'll do it for this. So whenever you sell your plant and machinery, in the column, in your from your books, like if it's a if the your plant and machinery is your in your main rate pool, if it's in the main rate pool, okay. Then whenever you dispose any asset, you'll deduct it, okay? You'll deduct from the balance from the pool because that asset is sold no more a part of the company, so you'll deduct it. Now you will deduct it at lower of your sales proceeds or your disposal proceeds, you can say, or your original cost, lower of your disposal proceeds, full proceeds, or cost of that asset. Okay. So you'll whatever the value, whichever the value is lower, you will take that value. Okay. Now what happens sometimes the balance of the pool is negative. Uh, for example, your main rate pool balance was 5,000 because how you get the 5,000? You purchased an asset like let's say 20 years back. You purchased an asset, let's say 20 years back. Now, whenever you purchase an asset 20 years back, now within these 20 years, you calculated the annual allowance. Okay, you calculate written down allowance every year, which is if it's main rate pool, then 18%. Okay, if you are selling any asset from special rate pool asset, then you did 6% of the annual allowance every year. All right, so that's why your balance get reduced. Okay, so if your balance is 5,000 and let's say your value, your lower of your disposal proceeds and cost is 10,000, you get the 10,000. So this is the 5,000. 5,000 is extra, right? So now this 5,000 is known as your additional allowance claimed. Okay. You can also you can say it as a balancing charge. Okay, balancing charge. Okay. Now what happens if you have claimed this additional allowance? Now, if you have this is extra, right? You get the negative balance. Now you cannot claim any annual allowance on this. Now, whenever you used to do annual allowance, whenever you get annual allowance per year, you deduct it from profit, right? Profit minus allowance, capital allowance, right? You get tax adjusted profit, right? So now here what we'll do, this is the additional annual allowance you already claimed. Now you have to add this to the profit so that you will tax it. So this will be, so the treatment for this will be profit plus your balancing charge, balancing, balancing charge. So if you do this, this will by default, this will automatically get taxed rate, right? Whatever the rate is, this will automatically get taxed. Okay. So this is your whenever you sell your asset. Till now we did whenever you purchase your asset. There's one more, a small concept, which is your small rate pool. Small pool allowance, small pool. Okay. What happens like per year after reducing everything, after suppose you have your main rate pool, okay? Suppose you have main rate pool. And after reducing, your balance of your pool is remaining after claiming all the allowances. Balance of the pool is less than 10,000. Sorry, less than 1,000. Then this whole 1,000, any main rate pool or SRP, okay? Then this 1,000 will also get directly annual allowance. Will also this will also be directly deducted from your pool. Okay. So suppose your main rate pool was 1,000 and you have this annual allowance column, right? You have this annual allowance column, right? So you'll deduct this and this will directly added into the allowance column. So you directly get the allowance whenever your pool balance falls under 1,000. Okay, that is the rule. Now this is time apportioned. This is considered for the 12 months period. So if you have period of more than that, okay, if your accounting period is more than that or less than that, it will be time apportioned. Okay, time apportioned. Again, this 1,000 divide by 12, whatever the period is. Okay, here I'll if it's for 8 years, sorry, 8 months, you'll write 8. If it's for 13 months, you'll write 13. You'll multiply by 13. Okay, so you'll get whatever the number of months is. Now let's do a question. Just a second. Let's do your test your understanding 3. Let's do your test your understanding 3. Gloria has owned and run her own business for many years. She prepares accounts up to 30th June each year. Okay, so year end is 30th June each year. During the year ended 30th June 2024, the following transactions took place. On 21st July 2023, purchased a car with CO2 emission 42 grams kilometer for 24,000 main rate pool asset, right? Less than 50. Okay. 14th August 2023, sold a piece of land for 12,200. She has paid 15,000 when she acquired it. Okay, so this is a sale transaction happening. Okay, and purchase a plan for in 19th November 2023. Purchase a plan for 1,84,500. The tax written down value at 1st July 2023 was 21,000 to 21,000. Okay. Logically, if you think, many students will find it, you'll get confused that this is the tax written down value. What is this? Whether this is a main rate pool tax written down value or special rate pool. Okay. Once we proceed further, you'll get this confusion whenever in the question it is given directly. So is there anywhere in the question mentioning anything about the special rate pool? No, right? uh Once we do the cluttered question, like everything is mixed up, you'll get confused. So here one thing is I'm making very clear, sometimes in the question not everything will be written. You have to think logically. If nothing is given regarding the special pool assets, then definitely whatever in the question it's talking about, the pool carry forward or brought forward balances, this is only talking about this main rate pool balance. Okay, how can it be special rate pool? No, right? If it's special rate pool asset given, suppose it was given that a car is having CO2 percentage more than 50%, let's say 57 or whatever the percentage is, and nothing else would have been given, and you sold that car, so you know that falls under the special rate pool. And if it's given that lift or escalator system or heating system is given, so that will be a special rate pool asset. Then you won't think about the main rate pool. Here it is given the main rate pool. That's why I know that this is a main rate pool asset, and that's how you will also know it. Okay. And the tax return on value at the 1st July, okay, 21,000. Annual allowance for the year end 30 June 2024. Um, hmm, this is the year start, right? Assume the tax year 23-24 rules will apply. Okay. So Gloria Company, let's do this. So year end. Oh, great. I can copy the format. This much is fine. But for you guys, you have to write it. You need practice, right? That's why you need to do it, right format. Okay. 30th June. 30th June. What is the year end? 30th June 2024. Okay. Main rate pool. Okay. Here you will write that text written down value brought forward. Okay. Because it was brought forward balance, and which is your 21,000 is your brought forward balance. So you will add it. Okay. Good. So here you had your 21,000 of the brought forward balance. Now you purchased a car on 21st July with CO2 emission of 42,000, and you sold a machine. Sold a piece of plant and sold a piece of van. Okay. Additions. Here you don't have plant and machinery. There is a plant and machinery, right? Yes, it is. It is. So I'll directly add into this. Okay. Plant and machinery of 1,84,500. What is the period? This is for the 12 months. Yes, this is again for the 12 months. Full 12 months, right? So, sorry. I have full 1 million available. Out of 1 million, I'm deducting 1,84,500. Okay. And my main rate pool balance will be again 0. Oh, it will not be 0. Just a second. That's one. Okay. Main rate pool balance will be 21,000. Now for the cars. Purchased a car with CO2 emission, which is 24,000. So I'll write 24,000 here. Okay. Now, just like we made additions, now I'll make the deductions column. Disposals. Disposals column. Okay. And whatever disposals we need, I'll do it here. Okay. So first of all, I disposed of your I disposed of a plant. Okay. So disposal will be considered as lower of. I'll write here only, so you don't get confused. Lower of cost or disposal proceeds. This disposal proceeds. Okay. So what is the cost of your plant and machinery? You sold for 12,400 and she paid 15,000, right? So which is at loss, right? You disposed it at a loss first of all. So 12,400, you'll take that lower of. So you'll take a plant which is 12,400 from the main rate pool balance. You'll deduct it. Now you will reduce the value. One more asset which you sold, that is your van. Now you purchased a van, sold a van for 700, paid for 600. Okay, 700 will be deducted. 12,000, 24,000. Yeah, there's some formatting you need to do. See, all the additions will be here. Then you'll do all the deductions. There will be a slight change in the formula for this. Okay. Okay, sorry. My bad. Your for van you'll take 600, right? Lower of your 700 and lower of your sales proceed or the cost. So 600 you will take it. You will get it 32,000. Now out of this 32,000 you will give the written down allowance, and this will only for your full year. Okay, this will not be for your whole sorry, this will be for the full year, so that's why I deducted that. So 18% annual allowance, this is your remaining balance, and this is your annual allowance for the year ending 30th June 2024. June 2024. Okay. See, if it was this one. Yes. The balance of this, the main rate pool, if the balance of main rate pool was negative, instead of positive 26,200, if it was minus 26,240, then you would have deducted, you would have added this, okay, added this into your profit, okay. And whatever the allowance column is, from the allowance column, you would have deducted it. This is the extra, right? So you would have deducted this one. So in the next question, test your understanding 4. You have this. I want you guys to practice this so that you can get it. And if you don't, if you find it difficult, you can ask me later on. But yes, I want you guys to practice this. So today we did, I'll just sum up. Okay. Okay. So today we started with your capital allowance chapter. In that we did the 3 types of allowances you get. One is the annual investment allowance. Second is the written down allowance, which is SRP and main rate pool assets. The SRP assets, on SRP assets you get the written down allowance of 6%, and main rate pool you get the written down allowance of 18%. Okay. And we also studied for cars, okay, rules for cars. And then you have the following, sorry, not following, first year allowance, this one. So we also studied your first year allowance, okay, this one, first year allowance. And we studied then your, whenever you dispose your asset, okay. So whenever you dispose your asset at that and at what value you take it, when you are disposing an asset, you take the lower of cost of sales proceed, you will deduct from that value. And if you get the whatever the pool you are deducted from, whatever the pool you have deducted the asset, if your pool balance is negative, how if you the value or you did value you reduced an asset, you deducted an asset, value is higher than the pool balance, then you'll get the negative balance. If that's a negative balance, then you'll add that negative balance into your trading profit, okay, so that you'll have to pay tax on that. Now whatever the allowance column that you have, from that allowance column, that pool balance that will be deducted, okay. Uh, okay. So yes, and also we also studied the small rate pool. So in the small pool balance, what happens if your pool balance is falling under 1,000, you will give allowance for the whole balance, whatever the balance is. Okay, then it will be a nil balance. And pool balance will be zero, and whatever the balances, you will give whole as an allowance. Okay, so that's it. We studied till now. I want you guys to read it from study text or read it from the this one, your ACCA study hub, anything is fine. But please make sure you read it and please make your own notes so that you can go through it, okay, towards the end. It's okay if you make it in Word file or if you note it down, it's fine. But yes, please, solving part, you have to do it on your Excel sheet. Okay, so yeah, that's it. Bye, guys. See you guys in the next class. Bye. Have a good day.